Good afternoon, everybody. This is Steven Padernacht with another episode of Mortgage Matters. Today is episode 13, and we are going to cover some of the recent mortgage news. I'm sure a lot of you have realized that the rates have kind of started to trend upwards. I actually saw an article that they were the highest they've been since November, so that's not necessarily good news. So we're going to talk about that today. And then what we're going to do is we have something special where we're going to do a mock application for self-employed applicants. It's a little bit different than the W-2 applicants when you are just an employer. So buckle in, and I'm going to introduce my co-host, Christian Babcock. Hello there.
Hello there.
You are in a new setting, my friend.
Nice little surprise there for you.
You are in a new setting. Where the heck are you?
I am in my office in White Plains.
Oh, wow. All right. Cool. I like that setup, man.
You are seeing a view of beautiful downtown White Plains, North Broadway from there.
I like that setup, bro. I like that setup.
I thank you.
And I see you're very casual Friday. You got the
A little
memo.
casual today. Got the Loan Depot swag going. So just trying to represent.
How's everything going?
Good. Can't complain. It's Friday.
Yeah.
So
What brings you into the office today? Did you just have some paperwork, or is this going to be a new thing for you?
No, I mean I'm in a lot during the week. I'm usually not in on Fridays, but I had some appointments I had to take, so I came in on Friday. But yeah, usually I work from home Fridays and Mondays, but now I've been coming in a lot more regularly.
Yeah, the business is booming right now, huh? Like there's just is that what it is? Like you're just busier where you got to handle more stuff in the office?
Yeah. I mean it's just a combination of things. I mean I manage 15 other people, so I gotta be here for my people. They
Of course.
some people come in, come out. We have sales meetings, and so yeah, I try to come in as much as I can now.
Good. Well, I gotta say, man, I like the background. I like the background.
Thanks, man.
Yeah, I switched it up a little bit too, as well. If you notice, my background's a little bit different today.
Mm-hmm.
My assistants had set me up on this wall so they could sit in my office as well. So they're sitting over there, in my normal area.
Nice. Okay. All right. That's cool.
So I think the first thing I'd like to talk about is the recent news. So why don't you fill me in a little bit here?
Well, I mean, it's following kind of a pattern from what I'm noticing. I mean, I heard what you said earlier. I mean, rates, they're definitely not as high as they were in November. Average 30-year fixed rates in November were touching 8%. Now we're just touching 7%. So we're still down, considerably since November. But the pattern kind of has been, we're getting all these economic reports coming out there in the month that seem to lead to inflation cooling off. But then when the actual inflation reports come out, it's not, it's not translating into the inflation reports that are actually coming out. So then we see kind of this immediate spike, as much as 0.5% in just a matter of days. And then we start getting some days where different reporting, conflicting information comes out that might be showing a cooler inflation forecast, which then causes them to trickle back down. So I've noticed the pattern anyway, that it's been going on since January. Same thing happened in February. Same thing happened in March. Now here we are in April. So we'll see. So I mean, it's a very tricky environment when it comes to locking in people's interest rates at the right time, especially in New York when we don't know when loans are going to close. So I try to keep my people informed and educated and know what's going on in the news and what impacts interest rates. We watch them together. Some people I hear from almost every day about what's the latest, and then we'll decide the appropriate time to lock in a rate, based really mainly on when they're still planning on closing. So it's very difficult market. It's really hard to navigate with this much volatility.
You could say that again. So which reports came out most recently, you think, that maybe might have impacted what we're seeing right now?
It was the CPI and PPI reports, which are the main inflation indicators that they put out once a month.
So CPI is Consumer Price Index, right?
Mm-hmm.
and
CPI
PPI as
is
well.
producer price index. So yeah, both of which are leading
Producer price
indicators.
index. Gotcha.
Right, they're both leading indicators for inflation going forward. Um, they put out a forecast, a consensus forecast of where they think they're going to come out, and then when the reporting comes out, either on point, you won't see much of a reaction. If they come out cooler, if those reports come out cooler than expected, you'll see rates actually kind of drop down. But if they come out hotter than expected, that's when you see them spike back up. But again, once we start getting other reporting during the month that shows some indication that inflation might be slowing down, the rates start to come back down, but a lot slower than they go up. They go up real fast, back down. So that's
Of course.
kind of been the trend, right? So
the consumer price index. Can you just kind of just expound a little bit? That is what? That is how much money people are spending right now, essentially, right?
I will lead you right to the classic definition of what that is. Let me.
Hey, Christian, you there?
Yep. Hello.
Yeah. You hear me?
I can hear you.
Can you hear me?
I can hear you.
All right, cool. No, I lost you for a second. The Wi-Fi is going in and out. Gotta love technology, huh?
Gotta love technology.
Yep. Fairly good. All right. Can you hear me better now?
I can.
This is crazy. Okay, hold on. I think that's better. Okay, I can see you moving.
I can hear you fine. Can you hear me?
Okay, good. All right. So I'm sorry. The CPI, Consumer Price Index. Can you just kind of school me a little bit on that?
So yeah, I'm literally reading it from the definition, so there's no confusion here. So CPI measures the price of. I got to make it official. We're on. We're streaming here.
Of course. Of course.
Yeah, CPI measures the price of predetermined set of goods and services purchased by urban consumers, which is 80% of the population. CPI is the most widely cited inflation indicator and is used to calculate cost of living adjustments for government programs. CPI tracks prices of goods in several main categories, including food and beverage, energy, housing, apparel, transportation, medical, education, and others. Excluding food and energy, which are the most volatile components, gives what is commonly referred to as the core rate, so core CPI.
Mm-hmm. Gotcha. Consumer Price Index. When I was in school, I never would have thought that I'd be watching these reports and having them literally hanging on by a thread, trying to figure out how they're going to affect my day-to-day life.
Yeah.
And look at us now.
I used to call in Fordham. I used to call economics sleeponomics.
Yeah.
I had an 8th period. So like senior year, it was, that was different times.
All right. So what advice are you giving right now to buyers and sellers, really? It's kind of just watch the markets and kind of try to time it right. Correct.
If that's possible, I do try to catch a dip when we get them. I used to really recommend people float their rates until the very end, mainly because of timing.
Yeah.
Other states, like I'm doing loans in Florida, I'm doing loans in, Connecticut, where you have a 30-day close, 45-day close. It's very easy if somebody's happy with the rate and you don't want to risk the volatility, you lock them in. In New York, again, as you know, it could be 30 days, could be 60 days, could be 90 days, could be 120 days before we're closing. Whether it's a co-op or whether there's a title issue or all the other things that go on. So it's, in this market, we have to really be a little more savvy and watch not just the market, but also the timing of every deal. If I lock somebody in for 60 days, their rate's just going to expire in 60 days. And then we're going to either end up losing that rate or taking what they call worst case pricing if it expires, or charging hefty extension fees to keep the rates active.
Yeah.
So with all that going on, I try to advise my clients first and foremost when they're based on when they're actually going to close. And in some cases, there's been a verbal agreement between buyer and seller on a target date. There's always an on or about target date in their contract, which, as you know, can be moved, and usually is always moved. So I always really try to keep the line of communication open between buyer, seller, and the attorneys to say, like what are we thinking? Like, let's say there's no issues with title or no issues come along. Like, when does the seller, more importantly, when does the seller want to leave the house?
Yeah. That's that has been such that point alone. I'm really glad you brought that up. It's been such a hotly negotiated sort of item over the past 6 months. I've seen it literally in half of my deals. Okay, the seller doesn't want to leave until, like, a perfect example, a deal that we're working on together, without giving the address, but they didn't want to they wanted to let the school year finish so they could finish with their kids.
Right.
But but they put it on market back in February. We went into contract in March. So we're talking March, April, May. They wanted an end of June date. And just the market is, there's such little supply out there that the buyers are willing to say, hey, you know what? Okay, cool. I'll wait.
Yeah.
And I'll wait, which, listen, it's fair that the seller says, hey, I want to wait until after the school year. You got kids, you want to understand, but it definitely does affect the timing. I mean, the sellers are saying all the time, I want to be out fast. I don't want to be out fast. They're really getting to dictate these terms in this market.
Right. And they always will dictate the terms. The seller owns the house, and because there's no set date in a New York contract on pinpointing exactly the closing date, like in other states, that's the kind of stuff we run into, because the seller will really dictate when it's going to close. We can have, I have 10 loans clear to close sitting in our closing department that are just waiting to be scheduled. And also you got buyer's attorney, seller's attorney. If it's a co-op, you got a co-op attorney. You got managing agents. You got all these people that need to be there physically, and all those schedules that have to be coordinated to get somebody to the closing table. So for that reason, it's always been tricky locking rates with enough time to close. So we got to be a little more sensitive to market conditions and how those rates are being impacted, so we could advise our clients appropriately.
Makes sense.
I tell people all the time, I was like, both literally and figuratively, the seller holds the keys to the house. Seller holds those keys, and the seller is going to tell you when you're going to close, no matter what happens. And the most you can really do, if it goes too far out, is threaten to walk away from the deal, and then you don't get your house. So it's not really a bluff. Most buyers are willing to play. So,
Well, I think I think that's really a representation of the fact that it's a seller's market. And because if there was if there was 100 houses that looked just like that one, the buyers would be able to dictate it. But because of the fact that we're in the seller's market, they're able to dictate the terms a lot more.
Well, right. So, but it all goes, by everybody's plans, which is why I tell my realtor partners and borrowers and everybody else, like, make sure that we're communicating either through the agents or, however that communication is getting between buyer and seller, as to, and not that anyone's held to it, but just a target. Give me an idea. We talk, because I have a bunch of people right now in process that already had pre-negotiated that they're not closing till June or July, and that's just the way that they want it. So we're not locking those rates in probably till sometime in May.
Yeah, because how long do the rate locks? A rate lock last for what? About 6 weeks?
A standard rate lock is 60 days. There are extended rate locks. There's 75, there's 90s, there's 120s. We even have ones that lock for the whole year. But those rates are really were created and intended for new construction, building, houses that might not be finished for 6 months to a year, where we have a long-term lock strategy. But your standard is, 60 days,
Gotcha.
For the sharpest rates.
Yeah.
The further you extend out the lock-in period, generally the higher the interest rates are, slightly.
Gotcha. Okay. So, well, thank you for that update. How'd you like to do the mock application for myself, who is a self-employed borrower?
You do that? Yeah, absolutely.
If you don't mind, just because last time we did a W-2 standard employee, 2 years of employment history. Yeah. And, we'll kind of play it just like I'll kind of give you some information, just kind of based on like what a realtor's real life situation would be.
Okay.
So Okay, so I'm looking to buy a house. I'm looking to be in Rockland County.
Okay.
I'd like right now the prices in Rockland County for the houses that I'm looking for are anywhere from 750 to call it 850,000 dollars.
Mhm.
I've got well, is there a required down payment for this type of house because I'm self-employed?
Not solely because you're self-employed. No. In conventional loans, you can do even as little as 3%, 5%, 10, 15, 20. It really depends on where you want your payment to be and how much cash you have.
Okay.
But yeah, just for being self-employed, there's no um, additional requirement for down payment.
All right, so I've got 100,000 as a down payment, plus I've got about another 25 or so for closing costs.
Okay. So I would probably tell you you've got enough to do 10% down, to cover everything with closing costs and everything and leave yourself a little more reserves.
Okay, so what kind of information do you need from me?
Nate, well, what's your occupation? Borrower.
All right, so I'm a realtor. I'm a realtor.
Hard stop.
Yeah.
How long have you been a realtor?
I've been a realtor for 5 years.
Okay. So,
and I just want to disclose everybody, this is not real life stuff. I'm just giving an example. Okay, I've been a realtor for 20 years, but this is an example.
Well, you can say 20 years. This is you. You can say 20 years.
Yeah. I've been self-employed for the past 20 years, but I do have an LLC that I give myself pay stubs from.
Okay. So, and the reason that I put my hand up is because usually I do that. As soon as somebody tells me they're self-employed or they're in the type of occupation where they're going to, they file their taxes either through an S corp, an LLC, and a simple Schedule C. I usually at least pause the conversation and say, I'm letting you know now, like I'm going to need your tax returns for me to accurately qualify you.
That's great. Okay.
And I tell my realtors the same thing, that if you're having those conversations with people when you're showing them a house, if they say that they're self-employed, give them the heads up that when you speak to my lender, they're going to need your tax returns.
And now you need my corporate tax returns and my personal, right?
Right. So, and it depends on how you file. So sometimes people will file on a Schedule C on their personal return. Like if they're consultants, they're getting maybe just a 1099 from a couple places, they'll report that on their personal return. If they do have a separate return, that you could also do that with an LLC. But if you're having an S corp or a separate LLC tax return, we need both. I would need the corporate return plus the personal return. So, okay. And the reason I say that again is because I've had more instances than I can count that I ask somebody, what you're self-employed, okay, how much do you make per year? And they'll always give me the top line. Which again, not being an accountant and not doing your own taxes, if you are looking at how much money you actually brought in, depending on the type of business, that's going to be one number. Yeah. But when we're qualifying for a mortgage, we're looking at the bottom line.
Gotcha. So you're not looking at the gross receipts or the gross income that came through my bank account. You're looking to see after expenses what the company actually netted as a profit.
Exactly. So without digging into the exact line items and everything else that we look for, I just tell people before we get any further, I want to make sure you have access to your tax returns either electronically. Yep. Sometimes people only have them hard copy, so they got to scan them in, or they got to bring them into the office and we scan them in, or however it is. But assuming that they have electronic copies on PDF, that's ideal. I'll even have them connect me directly with their accountants so they can send them to us directly if they're password protected or whatever else. But just know that, again, ahead of time, if you have those clients, it will help speed things up if they have those things ready. Because otherwise, if I'm chasing somebody for a few days and, then we got to continue to follow up and make sure that they're getting it. And then I get the call from the agent saying, what's taking so long with the pre-approval?
It's because they don't have their taxes, buddy.
Right. Right. So we try to turn things, around as quickly as possible, because especially I'll get those calls where somebody's already looked at a house and now they want to put an offer on it and they haven't.
Forget about it. Forget about it.
We got to really try to get these things done as quickly as possible, because that house will be gone in 48 hours. So again, now different loan types require different tax returns. So FHA loans, for example, we need 2 years, and then we would average those if the income is increased. If the income year over year has decreased, they'll go with the lower, more recent year. So if 2023 happened to be a worse year than 2022, we're going to go off 23.
Gotcha.
If it was a better year, they average it for FHA loans. So
don't you love that?
Yeah. So, but with conventional loans, when you have a larger down payment and you're self-employed for more than 5 years, we can use just the most recent 1-year return. So instead of averaging it, but if you're self-employed for less than 5 years, they're going to do the same 2-year average. So there is a difference there on conventional versus FHA, and depending on the down payment, it could be enough to have enough income there in the 1 year that we're looking at, as opposed to averaging 2.
All right. So my company. All right. So I've been employed. So I've been self-employed for 6 years, and I do have access to my tax returns.
Right. So we're going to be. I still would look at both, because once I input everything in through DU and LP, which are the two underwriting engines for Fannie Mae and Freddie Mac, they will come back with whether or not we need 1 year or 2. So I'll always get 2, and I'll run with the first one and I'll run it through. And if I get the the 1 year result, then I'll go off the 1 year.
Which, when you say 1 or 2, you're talking about my tax returns, right?
Tax return years, correct.
Gotcha. All right. So I'll email. So assume that I emailed you over my tax returns.
Right. So, it's essentially from there. I mean, again, this is like the full doc way of doing it. So full documentation is exactly that. There's a requirement because of with Dodd-Frank that we prove that somebody can afford the monthly payment for their primary residence. So, and that's all a result of the foreclosure crisis and Dodd-Frank and, the new laws that were in place, that we have a federal obligation to prove that you can afford this payment that we're giving you.
Yeah.
So a lot of times with self-employed borrowers, if they, and I get that all the time, people literally will say like, oh, I'm self-employed. So like, what that means.
Nah, don't worry. Christian, don't worry. I can afford 10 grand a month. Don't worry about it.
Right.
Don't worry about it.
Right. So again, so full documentation is always where I will start, because those are where the best rates are. So rather than just jump to a different type of product that might be easier for me, but higher rates for the borrower, I'll always try to go full doc first.
So what do you need from me?
What's that?
What do you need from me?
Just the
what is full doc? What does full doc mean?
So full doc is what we're describing, where I'm looking at your tax returns to calculate the income that you need to support the monthly payment. It's going to be fully documented, with tax returns, whether or not you pay yourself pay stubs, W-2s, bank statements, fully documented.
All right.
So now we look at that. If I look at your income and I say, okay, well, based on a $700,000 house with average taxes between $15,000 and $16,000 a year, which is described in Rockland, it's about average for Rockland County. We'd have to make sure that you have enough income on a monthly basis to support that monthly payment.
Gotcha. Now, when you say income, my business just needs to be able to make that much money, not me personally, correct?
Both. So if it's a single member LLC, you'll have, that's basically your money. Sometimes people will pay themselves a salary, but then the business made money. That doesn't always necessarily translate onto the personal return. So in that instance, we can actually use, in a single member LLC, we can use the income from the business also.
Okay.
But on S corps, it's also filed differently. S corps, you'll have somebody might be paying themselves a salary, but then they're taking distributions on a K1. So we would look at that as an average, or whether it's just a 1 year. Look at the income from what basically translates onto their personal return from the business.
Gotcha.
So there are line items on the business return that also need to be deducted in some cases from the income from the borrower. Which is why we need the business and personal, because it's not, if I just look at the personal and I say, okay, they paid themselves a W-2 and then they got a K1 distribution. If they have more than 25% ownership in that business, they have to take some of the other expenses off that are on that corporate return off of their personal income. So, and that's where a lot of loans, I think, get screwed up later on, is the loan officer's not looking at that up front. And the underwriters find deductions later that they have to now reduce the income. That can blow up your ratios.
That's interesting. What kind of expenses? So I just want to make sure I understand that correctly. So if I pay myself from the corporation, but I'm using my corporate taxes, there's I can't use the entire dollar amount. What kind of deductions? What other ones have to come out?
So it's like notes and bonds payable in less than 1 year is one that's buried in the return that needs to come off. We can actually add back depreciation. So if anything's being depreciated through the business, equipment or whatnot, we can
Wait,
actually.
depreciation can be added back in and counted as income. Am I correct?
That's right, right. So that can be added back in. Notes and bonds payable in less than 1 year gets deducted. Even the meal deduction, because they only take 50% of that, that actually gets doubled. For meals and entertainment, we actually have to reduce that. And then there's another one that's come up lately as a result of COVID, where businesses got a lot of grants, from like all the COVID distributions for self-employed borrowers, and that's listed as other income.
Okay.
That actually has to be deducted because it's not recurring income.
That makes sense. That makes sense. That makes sense.
Right. So if a business was getting, that kind of subsidy through because of COVID through the government, and they would list that on their tax return as other income, that needs to be come off too. And that could be a significant number. It could be a big number.
And your average person is not even seeing these things, right? So like because listen, let's be, call a spade, right? Like when I go to my accountant, I'm like, here you go, here's all my paperwork. He gives me back a document, tells me how much I owe, I sign it. And that's what your average person does, or they go on TurboTax, or they do whatever, TurboTax is not really let's not go that route because that's more for like W-2s, but like your average person just goes to their accountant, hands them his paperwork. All right, sign it. How much do I owe? Right. Oh, my accountant, great. I only had to pay X amount of dollars this year. Or my accountant stinks because I had to pay more this year.
Well, and that's the challenge that the accountants face is that, their job is obviously for you to have the least amount of tax burden, which causes people to write down their income, legitimately, and they're allowed to do that. But this is where kind of accounting and mortgage guidelines collide, because if the income is too low, then you're not going to be able to have enough to support a mortgage. Yeah. So in some accountants, I find mistakes on the tax returns all the time. I just had a guy this week that I had his personal return and I had his business return. The personal return was showing the K-1 distribution, which was on the corporate return, the S corp return. But then the S corp return showed wages going to officers of the company, and he was the only officer. So I was going back and forth on email. I was like, "There's a W-2 somewhere that you paid yourself that's not on your personal return. Should be on the W-2 line." And he's going back. He even pushed it to the people that were doing his taxes, and they just threw an easy answer at him, like, "Oh, no, your income is on the return," and they were just pointing to the K-1. So I had to literally like copy and paste the parts of the corporate return to him and say, "No, like, look, here's the W-2 income. Here's your name on the return that it says it went to you. It's not on your personal return." And he went back with that information to the accountant, and then, "Oh, yeah, you're right."
Yeah.
I mean, that would have been snagged much later, probably by the IRS. But again, so I mean, there's mistakes are made, anywhere, and they're always human. But the accuracy is really what we have to, especially, and I say it all the time, like the single most important part of a mortgage application is the income. And the reason I say that is because everything else can kind of be fixed. We had Mike on here a few weeks ago. Mike can help people fix credit. If people need down payment money, there's grants. We have first-time home buyer stuff. We have ways, that you even can pull out seller's concessions in a buyer's market, to kind of figure out the assets. People get gifts, or they can pull money out of retirement accounts. So we can always put that stuff together. But income is the one thing on the application that just can't be changed or manipulated. It just is what it is. And if it's done wrong in the beginning, your loan falls through in the end. And I get those calls all the time. I get another one just yesterday was saying that the bank that they were working with for several months, towards the end of the process, just told them they got to put 30% down now to qualify for the mortgage a month and a half later. And I said,
after they have an accepted offer, probably after they've gone through signed contract.
Oh no, they're in contract. They think they have a commitment letter, the whole 9 yards. And now they're being told they got to put 30% down. So I said, did they explain to you why? And no, of course not. They didn't explain why. They just said, "This is what, if you want to get the loan, this is what you got to do." Basically, it's the answer that they got. So I said, really, the only answer I could figure out based on that limited information is that somebody messed up the income, because what they're trying to do is get the debt ratio back in line. And the only way to do that is to either add more income or reduce the loan amount. Right. So you can't raise the income. So that's there. It is what it is, so their only fix is obviously to reduce the loan amount or reduce the rate to try to get the payment to a level that now your debt ratios are back in line.
All right. So this is full doc self-employed. So I've given you my tax returns. I've been employed for 5+ years. I'm okay with doing 10% down. I'm pretty sure that I can get a house and be competitive at a 10% down number. What next? What else do you need from me? What's the next step?
Well, from you, I mean, again, we would verify your assets, we run your credit, and then we run a debt to income ratio calculation based on the income, the expense of the mortgage with the taxes and insurance, and your other expenses on your credit report to see if your debt ratios are under 50%, or if in FHA's case, you can go to a 57% debt ratio. So now if that's not the case, if your income is too low, that's when we can add a cosigner. That cosigners work out very well with self-employed borrowers because they can kind of supplement the income that's missing that we need to support it. I always preface that also with when I'm even having the cosigner conversation with people, I always say, listen, just because I can get you the loan doesn't mean you're going to be comfortable with the payment. So let's go over the payment. And more importantly, if somebody's co-signing for you and if they're not actually giving you money every month, just know that this is what your payment's going to be. So we're going to figure out a way to fix this, but you still have to be able to make that monthly payment.
Of course.
The guidelines will allow you to add as many co-borrowers as you want to bring the numbers in line, but who's actually making the payment is going to be important. And I think that gets lost. I think sometimes in the conversation when people are like just so eager to get the loan and then realize later how much it's actually going to cost. So I really try to focus my attention on that from the beginning. And then, so that's how you can kind of get creative with a full doc loan. You can add more income with a cosigner. They don't have to live in the house. They can be a non-occupying co-borrower.
Yeah. So maybe like a family member, like, for first time, for mom, dad, brother, cousin, like somebody that obviously trusts you and wants to help you to start the home buying process.
And I always tell the co-borrower, like, look, this isn't a life sentence. This doesn't mean that you're going to be on the loan for 30 years. In some cases people will, maybe they have another property that they needed to sell and they can't get get an accepted offer with a sale contingency. So they need a cosigner just to boost the income enough to carry the both houses. And then after they sell their other house, I'm doing a loan like that also, where I did exactly that. But they had 5% down. They needed cosigners because they needed to carry both properties. They couldn't get an offer accepted with a contingency to sell their previous one. So we closed them with co-borrowers. Now they've sold their house. They got about $250,000 from the proceeds of that sale. And now we're doing a refinance. We're bringing their rate down 1% because they actually closed last year at the peak of like the high, where rates were at the high. And so we're not only reducing their loan by the $200,000, we're also reducing the rate by 1%. And now they're getting the loan that they originally wanted, but we're kind of forced into doing it that way.
And these and everybody, please, who's watching or listening or who will be listening, this is the difference of dealing with people that have been in the business and that have seen all different types of scenarios. What you just explained, Christian, as far as like balancing two different properties, being able to get a co-borrower on the loan so that way they could buy the house and then refinance the second home, pay down a debt, like all that stuff that's not like normal lender sort of conversations, right? Like,
well, it's trying to be as creative as you can while, and operating within the guidelines. So, and again, with these people, it was exactly that conversation. The co-borrowers did not want to be on the loan for a long time. And we assured them that no, once the other house sells, our buyers are going to put down a substantially larger down payment and refinance because they can qualify for the loan that they have now. They just couldn't qualify carrying both at the same time. Gotcha. So now everybody's getting what they want. So they're not, and luckily for them, the success story was that they're also getting a reduced rate. So co-borrowers getting off the loan, they're reducing their rate and their loan amount. They're saving about, I think, $2,000 a month. And everybody's happy. And it's all happened within the last 6 months, both transactions. Right.
All right, Christian, we're running out of time today. I guess we will pick this back up next week, and maybe we'll start going into those a little bit more creative sort of situations. If I didn't have my tax returns, and we kind of
get into the non-QM stuff. It's, do that today, but we got into the inflation weeds. But we'll get into the non-QM stuff for self-employed borrowers, some of the more creative options that we have that are out of the full doc box.
Got it. Full doc box. Love it.
Doc box.
All right, man. Thank you so much for your time, and I'll see you next week.
Thanks, Steve. You got it,
All
buddy.
right. Bye.
Bye.